Welcome to The Bull and the Bear, a money and markets podcast. We give you the advice you need to know to make investing safe and profitable. With The Bull and the Bear podcast, you'll get exclusive access to some of the top thinkers, analysts, advisors, and gurus in the investment business. And now for your hosts, Matt Clark and Charles Sizemore. And welcome to an episode of The Bull and the Bear, a money and markets podcast. I'm Matt Clark. Glad you're with us today. Have a treat for everyone. One of the things we like to do here is just try to incorporate a lot of different voices into this podcast. And I wanted to reach out to one of my good friends, Ted Bauman, who is a noted economist, and he's also the editor of the Bauman Letter. He also is the editor of the Alpha Stock Alert, and he's also the editor of the 10X Project with Banyan Hill Publishing. And he is joining us today. Ted, first off, welcome, and thank you for coming on The Bull and the Bear.
It's a pleasure, Matt. Always good to talk to you. How are things down in Florida?
They're good. They're good. It's sunny. It's nice. A little bit of a breeze. So it's not too shabby. How about in your neck of the woods? You're in Georgia, so.
Yep. I had a good day out on the boat yesterday doing some maintenance, got a little bit of a sunburn even. So the year is progressing nicely as far as sunburns are concerned.
I'm a little jealous about being on the boat. I've told my wife that I desperately want a boat just so I can get out on the water. So
well, I was doing the part that nobody likes, which is all the maintenance. So there's that too.
Understand. To give a little bit of background to Ted, first off, I mentioned he's an economist. He's a very well-known economist. People know him. He's been on numerous networks, interviewed with numerous entities such as Forbes and Barron's, and he's appeared on numerous television programs to talk about the state of the economy, the history of the economy. But he's had his work, and Ted, if I get any of this wrong, please let me know. But he got his start in nonprofits. He worked with several nonprofit organizations in and around Africa. If you haven't noticed the distinctive accent, Ted spent a majority of his youth in South Africa, but he has since been here in the United States and has been providing his readers of all three of his products with a lot of great information, a lot of great recommendations, and using his background on the economy to really illustrate solid market picks that have produced some really good gains. I looked at your portfolios the other day, and Ted, they're doing well. You've got some really good winners in there.
Well, thank you, Matt. We like to think that we're prepared for all eventualities. Certainly, this was one that we didn't expect, but we've had to move quick on our feet. But I think the key thing is that our philosophy with the Bauman Letter in particular is really to be diversified, so that we have a number of companies that are really in there as stabilizers as well as just growth companies. So our strategy is working.
Yeah, and not a lot of people can say that, especially with these kind of market times being as volatile as they have been. But the reason why I wanted to talk with you today is, the state of the U.S. economy, the state of the global economy right now. Today, U.S. GDP was reported to have shrunk by 4.8% in the first quarter, which is the largest contraction of GDP since the financial crisis back in 2008. The CBO came out and suggested that the GDP will further contract around 12% in the second quarter, because I think what people don't quite understand is that the first quarter doesn't really factor in a large part of this whole coronavirus lockdown that we've experienced, not just here in the United States, but globally. And I think I read somewhere that, it could be up to 2022 before the U.S. economy fully recovers from where we're at right now. But first, Ted, I want to get your take on, let's start with the first quarter. Contraction, this is, the largest we've seen in over a decade. And I guess talk about why that is. Why, what has caused the contraction in GDP?
Well, I think people should be pretty concerned about that figure. As you said, the actual mandatory lockdowns didn't really start until close to the end of March. But what this figure tells us is that people were reducing their economic activity even before the mandatory stuff happened, and that's why I remain concerned about the second quarter figures and quarters beyond that. That it's not just what the politicians tell us to do, it's what common sense tells people to do. And a lot of people stayed home. they just didn't go to restaurants. They didn't go to gyms. They didn't go to any place. They didn't go to concerts. They didn't go to any big place, malls where they thought the virus they could be exposed to it. And we can lift lockdowns all you like, but people are not going to go out. I mean, here in Georgia, the governor has mandated that certain categories of companies can open, little companies in particular, and they're not, and people are not going to them. So my big concern is that if we see a 4.5% decline in GDP, or 4.8 or whatever it was for the first quarter, which was even before the mandatory lockdowns, just imagine what it's going to be like when you combine mandatory lockdowns plus people's reluctance to go out and spend. So, I'm on the bearish side when it comes to this thing. And one thing I will point out is when people say the economy will bounce back and will be back to normal, economic production that is lost is never regained. We've lost 4.8% of GDP for the first quarter, and that's never coming back. So that's money that people would have earned and would have spent that they're not going to earn and not going to spend in the future. So it's important to understand that the long-term impact of this is going to be to depress economic activity and to keep output lower than it would have been otherwise for years to come.
Yeah, and I think you touch on several good points there, and that is, the main thing here is that 4.8%, a lot of that's not going to come back. I mean, as much as we'd like to think it will, as much as we talk about economy stabilization or recovery, if you will, it recovers, but it only recovers to a certain level. It doesn't recover to a high of which it was at one point, at least not in a near-term situation, if I understand right. So, I'm with you. I think there's a big concern here that I think is being glazed over, and that is that we look at this, and I think people look at the headlines and think 4.8%. Well, that's probably the worst it's going to get, because that's just what it sounds like, and it's not. It's not by any stretch. The second quarter is going to be considerably worse, and we'll talk about that here in a second. But is there any one particular sector of the economy here that you see is taking the largest hit because of this contraction?
Well, certainly we've seen a couple standouts. One is energy. There's no question about that. The energy sector has just got absolutely hammered. I was looking at a chart earlier today that I'm going to use in a podcast that I'm working on for later in the week, and it shows that something like a quarter of the companies that in the energy sector are probably at this point bankrupt, and the only reason they're not closed is because of the Fed's backstop buying corporate bonds in the junk bond market. Right now, we're looking at almost $65 billion worth of distressed debt in the oil and gas sector. But there's another sector, and then on top of that, let's just get the obvious: hospitality, hotels, airlines, cruise lines, all that whole sector of the economy that's about travel and people moving around. That's also just being absolutely slammed. But here's some stuff that people don't think about. Media. One of the big problems with the media sector, and this includes companies like Facebook and Google and others, is that companies that are not selling stuff and that are trying to conserve cash aren't advertising. So there's $32 billion worth of distressed debt in the media sector right now, which is all the companies that cobble together adverts and place them on digital platforms like Facebook and Alphabet and Google and others. Those adverts aren't being bought, so these companies are in trouble. So there are lots of sectors where things are happening that people are not aware of. In fact, there's more distressed debt in the media sector right now than there is in retail and restaurants. So certainly there are lots of places where things are dire.
Now, looking ahead to the second quarter, which is where we're really going to see the real brunt of the coronavirus lockdown and the pandemic. And I think it's one thing that people are overlooking. The CBO, the Congressional Budget Office, released its initial findings earlier this week and suggested that the GDP will contract by about 11.8%. Let's just say 12% for the sake of argument in the second quarter. And I don't know, Ted, is that a conservative estimate, do you think, or do you think that's right on par?
Well, it's hard to tell. I think it's probably conservative. I mean, I think, everybody has an incentive to try to soften things at the moment, and there's a lot of wishful thinking going on. But remember, a lot of what's captured in GDP figures is not easy to capture until you've had things like income surveys, business activity surveys, and whatnot. That's why GDP figures are always released in two phases. One is a preliminary, and one is the final figure. And I think what we'll see is that it's difficult to capture the full scope of GDP loss even in the second quarter, because so much of it is happening in places that are hard to count, like retail and restaurants, the small business sector, basically. And, particularly what we're going to see is that the lack of spending from people who lost their jobs or saw reduced wages during the second quarter is going to take a while to filter through, because it's not just their lack of wage earnings that contribute to dropping GDP. It's also the money that they're not spending in stores. So you've got a multiplier effect that won't really be fully captured until the second reading of GDP. So yeah, 12 sounds to me like a pretty ambitious target at this point. I have seen figures from Goldman Sachs, which is a company that has a proprietary interest in getting these figures right. They say 20%.
Yeah, I saw that. I saw that too.
So, I mean, if Goldman Sachs is betting billions of dollars in its own trading on figures like that, you better believe they're probably correct.
Yeah, I think I have to agree with you. I think the CBO is probably a little on the low side in terms of its estimate. Now, to throw you a little bit of a curveball here, Ted, one thing that I think our listeners would be interested in is when you look at all this, I mean, because this is a very complex thing. The economy is not something that is easy to digest to anyone really, but as an investor, if I'm looking at these things and I see, okay, U.S. GDP drops by 4.8%, shrinks by 4.8%, it could be between 12 and 20%, even more so possibly in the second quarter. As an investor, what should I be doing now and in the next 6 months?
Well, I mean, as I've advised readers of my Bauman letter, we recently put out basically a bear market survival guide. And the number one thing I said to our readers was try to generate some cash in your portfolio. Try to beef up your cash reserves. That could include taking profits on positions that you're ahead on. Just sell back to the value of your original purchase and convert the profit into cash. You could sell marginal positions, but basically try to get as much cash ready, because what's going to happen is the stocks are going to bounce back. And if you are fully invested in stocks that have, let's say you're buying now, where we have this short-term, what I think is a short-term mini rally. Okay, you spend a lot of money buying stocks on the way up. Now, those stocks are going to decline in value, and you're not going to want to sell them because they've dropped in value. You don't want to realize your losses. Well, my advice would be hold off on buying some of those stocks right now. Keep the cash, wait for the real drip, which is coming. I've said we're headed for a double bottom, and buy it when it looks like we're close to the bottom. I've released a couple of YouTube videos where I talk about ways to tell that we've passed that second bottom, and it has a lot to do with the relationship between price and volume. And we cannot talk about a sustainable recovery in the stock market until we see both increasing prices and increasing trading volumes. We're seeing the opposite right now. We're seeing increasing prices but declining volumes. So that tells me that the best thing to do is what the big boys are doing, which is keep money on the sideline, wait for prices to go down a bit more, and then buy in to the stocks that are going to skyrocket.
I think that's great advice, actually.
It is. Well, having said that, there are a couple of sectors that I think have already hit serious bottom and are probably going to continue to rise now that people have realized that they were mistaken, and particularly the housing sector. It's not a popular position, but I'm bullish on housing producers, the big ones, like the companies that the national chains, the Pulte's and companies like that, because I think they are proving more resilient than a lot of people thought they would be. And so even now they're trading at PE ratios that are just outstanding. You want to buy those companies even now. So, but main thing is keep your powder dry.
I think that sums it up great. That's outstanding. And one last thing, Ted, before I let you go, when does this all come to an end? I mean, when do we see, I hesitate to say economic rebound, but when do we start to see things kind of taper off? Are we going to see Q4, Q1 of 2021? I mean, when do we start seeing things kind of pick back up again?
Well, it depends whether you mean the market or the economy. I think the economy, as I said earlier, this is a pretty serious blow, and I think it's going to take, quite frankly, years for us to recover the dynamism that we will have lost as a result of this. But there's also going to be a lot that changes and never goes back. I'm actually working on a script for a video today where I'm talking about what's going to be different afterwards, and one of the key things is companies are going to change the way they operate. And so I think what we're going to see is when things start to bounce back at the economic level, a lot of spending will be driven by the desire to change things like, for example, remote working. Companies may decide, hey, why have we been spending all this money on big office spaces in urban areas at high rents when we can actually farm some of our employees out to their basements or their living rooms or their kitchen tables? So I think that there's going to be a lot of short-term spending that's based on locking in some of the changes. As far as a solid permanent rebound from the virus, it's going to take a vaccine. And some economists may feel comfortable predicting that when that will happen, but I'm not one of them because that's not what economists do. We don't make vaccines. So I don't know. But clearly, the only thing, the smart people I've read say it all comes down to a vaccine. And that is not something that any of us can put a date on.
So the bottom line here from Ted Bauman, and a line I agree with: keep your powder dry in terms of your investments. Try to have some cash available, and try to keep yourself diversified that way. And Ted, I appreciate the time. Ted Bauman, he is a noted economist, Banyan Hill Publishing editor of the Bauman Letter. He also is the editor of the Alpha Stock Alert and the 10X Project. And in the show notes, make sure you check it out. I'll include links to how you can get some of Ted's good stuff. He puts out stuff almost every day, and it's definitely worth a read. Ted, again, thank you very much. Appreciate you joining us here on The Bull and the Bear.
It's a pleasure, Matt. Always good to talk to you.
Thanks a lot, and we'll be back on again on Friday. We'll have Charles Sizemore and hopefully Adam O'Dell will join us as well. So make sure you join us then. We'll have that up sometime on Friday afternoon, give or take. If you do have any comments, questions, concerns, anything like that, you can email us at thebullandbearpodcast@gmail.com. Right now, we are syndicated on Google Podcasts. We are also on Spotify, and we will soon be on Apple Podcast, as well as hopefully iHeartRadio and a few others. So make sure you check it out there. And so for Ted Bauman, I am Matt Clark. You've been listening to The Bull and the Bear, a money and markets podcast. You've been listening to The Bull and the Bear, a money and markets podcast. Tune in each week to hear insights on how to make investing safe and profitable for you.